All content provided by the rational investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. If this approach to blending Stoic discipline with financial strategy resonates with you, I warmly invite you to join our community. Hit that subscribe button to get weekly documentaries that empower you to navigate markets with clarity and fortitude. For more on tackling cognitive biases, check out our playlist on Stoic investing principles, linked below. Let's keep building your portfolio strength together, one rational decision at a time.
Epictetus and the Sunk Cost Fallacy. The freedom of abandoning irrecoverable errors. All content provided by the rational investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. Welcome to the Rational Investor, the definitive source for bridging ancient wisdom and modern wealth management. We specialize in high-level financial psychology, systematically dissecting the cognitive biases that sabotage investment success, from loss aversion and confirmation bias to the anchoring effect. Each documentary links the timeless wisdom of Stoic philosophers like Marcus Aurelius, Seneca, and Epictetus with specific, actionable strategies in quantitative and behavioral finance. Our mission is to help you master your mind, master your market. This channel is for serious investors, executives, and financial professionals who understand that superior returns are generated not by predicting the market, but by controlling the mind. If you are ready to build a portfolio of philosophical and financial fortitude, hit subscribe and join a community dedicated to emotional discipline and sustained rational investing. New documentaries are published weekly. How much capital have you destroyed by refusing to abandon a losing position? Not because the fundamentals justified holding, not because your thesis remained intact, but simply because you had already committed too much to walk away. This is the sunk cost fallacy, and it represents one of the most financially catastrophic cognitive errors in modern portfolio management. The ancient Stoic philosopher Epictetus understood something that most investors never learn. The past is categorically irrecoverable, and your attachment to it is the primary source of your financial suffering. In the next hour, I'm going to show you exactly how Epictetus's doctrine of control provides a systematic framework for eliminating sunk cost thinking from your investment process entirely. By the end of this documentary, you will possess a concrete methodology to cut losing positions with the same emotional neutrality that characterizes the most successful institutional investors. Let's begin. Understanding the sunk cost fallacy. Before we can dismantle this bias, you need to understand exactly what it is and why it has such a powerful grip on your decision-making process. The sunk cost fallacy is the tendency to continue investing time, money, or effort into a venture simply because you have already invested resources into it, regardless of whether continued investment is rationally justified. In behavioral finance terms, this represents a systematic violation of rational choice theory. A rational actor makes decisions based solely on marginal costs and marginal benefits going forward. But you are not a rational actor. None of us are. We are psychological beings operating with deeply embedded heuristics that evolved for survival in environments completely different from modern capital markets. The sunk cost fallacy is rooted in what Daniel Kahneman and Amos Tversky identified as System 1 thinking, the fast, automatic, emotional processing system that governs most of our daily decisions. System 1 is extraordinarily efficient for pattern recognition and immediate threat response, but it is catastrophically ill-equipped for probabilistic reasoning and long-term wealth optimization. When you look at a position that is down 40%, System 1 does not calculate expected value or analyze whether the investment thesis has deteriorated. Instead, it triggers a cascade of emotional responses centered on one overwhelming psychological need, the need to not have been wrong.
This is where loss aversion enters the picture. Loss aversion, another cornerstone concept from prospect theory, tells us that the psychological pain of losing is approximately twice as intense as the pleasure of an equivalent gain. You feel the sting of a $10,000 loss far more acutely than you enjoy a $10,000 profit. This distorts your evaluation of investment decisions. When you're holding a losing position, your mind is not neutrally assessing future probability-weighted returns. It is desperately seeking a narrative in which your original decision was not a mistake, in which holding long enough will somehow vindicate the capital you've already lost. Let me be precise about how this manifests in actual investment behavior. You purchase shares in a company at $100 based on a specific thesis about future earnings growth. The stock declines to $60. New information emerges suggesting your original thesis was flawed. Perhaps management has been more aggressive with accounting than you realized. Perhaps a competitor has introduced a superior product. Perhaps macroeconomic conditions have shifted in ways that undermine the business model. A rational analysis, performed by someone with no prior investment in the position, would likely conclude that the stock should be sold. But you are not someone with no prior investment. You have already committed 40% of your original capital. And here is where the fallacy takes control. Your mind begins constructing elaborate justifications for holding. You tell yourself the market is overreacting. You tell yourself you're a long-term investor and short-term volatility doesn't matter. You tell yourself that selling now would lock in the loss, as if the loss is somehow not real until you execute the sale. This last point deserves particular attention because it reveals the magical thinking at the core of sunk cost psychology. The 40% decline in your position is not contingent on whether you sell. The capital is already gone. The loss has already occurred. The sell decision does not create the loss, it merely recognizes reality. But System 1 does not process reality this way. System 1 treats the act of selling as the moment of loss, and so it resists selling with every cognitive tool available. This is psychologically comforting because it allows you to maintain the illusion of control. As long as you are holding, you can tell yourself the story is not finished. You can tell yourself there is still time for vindication. You can avoid the psychological confrontation with your own fallibility. And this is precisely why the sunk cost fallacy is so insidious. It does not feel like a bias when you are experiencing it. It feels like discipline. It feels like conviction. It feels like the kind of long-term thinking that separates sophisticated investors from weak-handed retail traders. But it is none of these things. It is a cognitive error that systematically destroys capital. The financial cost of this bias is staggering. Academic research has documented that individual investors hold losing positions approximately 50% longer than winning positions. This disposition effect, closely related to sunk cost thinking, produces measurably inferior returns. Terence Odian's landmark research at UC Berkeley found that stocks investors sold outperformed the stocks they continued to hold by an average of 3.4% annually. Think about what this means for your portfolio. Every time you hold a losing position past the point where your original thesis has been invalidated, you are not just failing to cut your losses, you are actively underperforming relative to alternative uses of that capital. The opportunity cost is not theoretical, it is quantifiable, and it is compounding against you. Moreover, sunk cost thinking creates a second-order effect that is even more damaging than the direct capital loss. It consumes your attention and emotional bandwidth. You become psychologically anchored to your losing positions. You check them obsessively. You read every piece of news looking for confirmation that they will recover. You construct elaborate mental scenarios in which they return to your cost basis. This attentional allocation is capital in itself, psychological capital, and you are deploying it in the least productive way possible. While you are fixated on rescuing your losers, you are not identifying new opportunities. You are not objectively evaluating your portfolio. You are not thinking clearly about risk-adjusted returns going forward. You are trapped in the past. And here is the deepest truth about the sunk cost fallacy, the one that brings us directly to Epictetus. The reason you cannot abandon losing positions is not fundamentally about money, it is about identity. When you make an investment, you are not just allocating capital, you are making a public or private statement about your judgment. You are saying, implicitly or explicitly, I believe this asset will appreciate. When that belief is proven wrong, you are not just losing money, you are confronting evidence of your own intellectual fallibility. And for most people, this is psychologically intolerable, so they hold. Not because holding is rational, but because selling would require accepting that they were wrong, and accepting that you were wrong requires a kind of philosophical sophistication that most investors never develop. This is where ancient Stoicism offers something that modern finance cannot, a complete reframing of what it means to make a mistake. Epictetus, the Stoic slave, who became one of the most influential philosophers in Western history, taught a doctrine that directly dissolves the psychological mechanism underlying sunk cost thinking. But before we can apply that doctrine, you need to understand one more thing about why sunk costs dominate your thinking so completely. The sunk cost fallacy is not just a cognitive error, it is a form of temporal confusion. You are allowing a past decision, a decision made with incomplete information in a different context, to constrain your present action. You are treating the capital you invested as somehow more important than the capital you still possess. But these are identical. A dollar you invested last year and a dollar you hold today have exactly the same economic value. The only difference is psychological. The invested dollar carries the weight of your past judgment. The uninvested dollar is free of that burden. And this psychological weight is precisely what prevents you from optimizing your portfolio. You are not managing money. You are managing your relationship to your past self.
Epictetus understood this temporal confusion better than any modern behavioral economist. His entire philosophical system was designed to liberate individuals from the tyranny of things they cannot control, and the past is the ultimate uncontrollable. What you invested yesterday is gone. The only question that matters is what you do with today. And yet you continue to allow yesterday's decisions to control today's capital allocation. This is not investing. This is ritualized self-punishment. And in the next section, I am going to show you exactly how Epictetus's teachings provide the philosophical foundation for a completely different approach, one in which you make every investment decision as if you were encountering the position for the first time, with no emotional attachment to your cost basis and no psychological need to be vindicated by future price action. The philosophical solution: Epictetus and the dichotomy of control. Epictetus was born into slavery around 50 AD in Hierapolis, in what is now modern-day Turkey.
Despite his circumstances, or perhaps because of them, he developed one of the most psychologically liberating philosophical systems in human history. After gaining his freedom, he established a school in Nicopolis where he taught Stoic philosophy until his death. His teachings were preserved by his student Arrian in two texts, the Discourses and the Enchiridion, which translates to handbook or manual. These texts contain what may be the most practical wisdom ever written on human decision-making under conditions of uncertainty, which makes them directly applicable to portfolio management. The cornerstone of Epictetus's entire philosophical system is what modern scholars call the dichotomy of control. This principle appears in the very first passage of the Enchiridion, and I want you to hear his exact words because they contain the complete solution to sunk cost thinking. Some things are within our power, while others are not. Within our power are opinion, motivation, desire, aversion, and, in a word, whatever is of our own doing. Not within our power are our body, our property, reputation, office, and, in a word, whatever is not of our own doing. Let me translate this into investment terminology, because when you do, the implications are profound. Within your power, your investment process, your analysis methodology, your position sizing rules, your sell discipline, your emotional response to market movements, your interpretation of new information. Not within your power, stock prices, market sentiment, macroeconomic developments, what other investors do, whether your thesis proves correct, whether a position returns to your cost basis. Now here's the critical insight that dissolves sunk cost thinking entirely. Your past investment decisions fall into the category of things not within your power. The moment you executed that trade, it left the domain of your control. The capital you deployed is gone. It exists now in the form of a current market position with a current market value. Your original cost basis, the price you paid, the thesis you held when you bought, the conviction you felt, the analysis you performed, none of these facts have any bearing on what you should do now. They are all in the past, and the past is categorically outside your control. Epictetus taught that human suffering arises from desiring control over things that are not within our power. When you hold a losing position hoping it will return to your cost basis, you are desiring something completely outside your control. You are desiring that past events had unfolded differently. You were desiring that your previous judgment had been correct. You were desiring that the market validate your ego. And every moment you spend in this desire is a moment of self-imposed suffering. More importantly, for our purposes, it is a moment of suboptimal capital allocation. The Stoic solution is radical in its simplicity. You must learn to distinguish with perfect clarity between what you control and what you do not, and then you must learn to concern yourself only with what you control. Epictetus writes, "Make the best use of what is in your power and take the rest as it happens." In investment terms, this means you control your analysis of the current opportunity set. You control your position sizing today. You control your sell discipline going forward. You do not control whether yesterday's investment performs. You do not control whether your past self made a good decision, and you must learn to view these things with complete indifference. This is not emotional suppression. It is not pretending you don't care about losses. It is a fundamental reorientation of what you define as success. For most investors, success means being right about their investments. This definition guarantees suffering because being right is not entirely within your control. Markets are probabilistic. You can perform impeccable analysis, construct a sound thesis, size your position appropriately, and still lose money due to factors completely outside your control. If your sense of success is tied to outcomes, you will be in a constant state of anxiety, and you will be psychologically unable to cut losing positions. The Stoic definition of success is completely different. Success means executing your process with discipline, regardless of outcomes. Success means analyzing positions objectively based on current information, not past commitments. Success means sizing positions according to your predetermined risk framework. Success means cutting positions immediately when your thesis is invalidated. Notice what all of these have in common. They are entirely within your control.
And notice what is absent. Any concern with whether you were right, whether you look foolish, whether you could have done better. Epictetus has another teaching that is directly relevant to sunk cost thinking, and it relates to how we form attachments. He writes, "When you are going to take something in hand, remind yourself what manner of thing it is. If you're going to bathe, picture to yourself what happens in the bath. Water splashing, people being jostled, some shouting abuse. And you will undertake the affair more securely if at once you say, 'I want to bathe, but I also want to keep my will in harmony with nature.'" Apply this to investing. When you are going to make an investment, remind yourself what manner of thing it is. It is not a statement about your intelligence. It is not a test of your worth. It is a probabilistic allocation of capital that may or may not work regardless of the quality of your analysis. Picture to yourself what happens in investing. Markets are volatile. Theses get invalidated. Unexpected events occur. Other investors behave irrationally. And you will undertake the investment more securely if at once you say, "I want to deploy this capital, but I also want to maintain my objectivity regardless of outcomes." This pre-commitment to objectivity is what allows sophisticated investors to cut losing positions without emotional turmoil. They have already accepted, before making the investment, that loss is a possibility, and that their willingness to accept loss is part of what makes the investment viable. They have not attached their ego to the position. They have not told themselves a story in which they're the hero who picks winners. They have simply made a calculated allocation with predetermined exit criteria, and they are prepared to execute those criteria with complete emotional neutrality. But Epictetus goes further. He teaches a practice that modern investors desperately need: negative visualization. This is the deliberate practice of imagining loss before it occurs. Before you make an investment, before you size a position, take time to vividly imagine the investment going to zero. Imagine the company going bankrupt. Imagine your thesis being completely wrong. Imagine having to explain to yourself or others that you lost money on this position. Do not do this casually. Do it with detail. Feel the emotional response, and then ask yourself, can I accept this outcome? Can I lose this capital and maintain my equanimity? Can I be wrong about this and not have it shake my confidence in my process?
If the answer is no, you should not make the investment. And if the answer is yes, you have just freed yourself from sunk cost thinking as a legitimate outcome. You will not be psychologically devastated when loss occurs. You will not need to hold the position, hoping for recovery, in order to avoid confronting your own fallibility. You have already confronted it. You have already accepted that you are a fallible human being operating in a probabilistic environment. And this acceptance is what gives you the freedom to cut losses with the same ease that you take profits. There's a passage in the Discourses where Epictetus describes the proper attitude toward possessions, and I want you to hear this because it applies perfectly to portfolio positions. He says, "With regard to whatever objects give you delight, are useful, or are deeply loved, remember to tell yourself of what general nature they are, beginning from the most insignificant things. If, for example, you are fond of a specific ceramic cup, remind yourself that it is only ceramic cups in general of which you are fond. Then, if it breaks, you will not be disturbed. If you kiss your child or your wife, say that you only kiss things which are human, and thus you will not be disturbed if either of them dies." This may sound harsh, but translate it to investing and you will see the wisdom. With regard to whatever positions give you delight, are useful in your portfolio, or are deeply loved, remember to tell yourself of what general nature they are. They are not statements about your intelligence. They are not proof of your market acumen.
They are simply positions among many possible positions. They are temporary allocations of capital that will either appreciate or depreciate based on factors largely outside your control. If you hold this view, if you see your positions as ultimately replaceable and contingent, then when a position deteriorates, you will not be disturbed. You will not cling to it. You will not throw good money after bad. You will simply exit and reallocate to more promising opportunities. This is the psychological freedom that Epictetus offers, and it is precisely the freedom that allows the most successful investors to cut losses ruthlessly. They are not more intelligent than you. They are not better analysts. They simply have a different relationship to their past decisions. They do not view their cost basis as meaningful. They do not view their original thesis as something that must be vindicated. They view every position, every day, as a fresh decision. Should I own this asset at this price, given what I know now? If the answer is no, they sell, and they do so with the same emotional neutrality that you might feel about switching from one brand of coffee to another. Now I need to address something that many of you are thinking. You're thinking, but doesn't this mean I'll cut winners too early? Doesn't this mean I'll lack conviction? Doesn't this mean I'll be trading frantically based on short-term noise? And the answer is no, because Epictetus is not teaching you to be reactive to external events. He's teaching you to be governed by principle. The principle is not sell when you're losing. The principle is make decisions based on present information, not past commitments. If your thesis remains intact, if the fundamentals continue to support your position, if your analysis suggests the market is mispricing the asset, then you hold. Not because you need to be vindicated, but because holding is the objectively correct decision based on current information. The difference is subtle but crucial. Most investors hold losing positions because they are attached to their past judgment. Sophisticated investors hold positions because their current analysis supports holding. The former is governed by ego, the latter is governed by process. And Epictetus's entire philosophical system is designed to help you move from being governed by ego to being governed by principle. When you internalize the dichotomy of control, when you accept that past decisions are outside your power and only present actions are within your power, you become capable of making every investment decision as if you were making it for the first time. This is what institutional investors mean when they talk about marking to market, not just their positions, but their entire thought process. They are not asking, what did I think about this position when I bought it? They are asking, what do I think about this position now? And they are willing to change their mind instantly when new information arrives, because their mind was never attached to the old information in the first place. They were simply making the best decision they could with the data available, and they remain open to making a different decision when different data becomes available.
Let me give you a concrete example of how this plays out in practice. Imagine you purchased shares in a retail company based on a thesis about expanding margins through operational efficiency. You paid $50 per share. 6 months later, the stock is at $35. New information emerges. A key executive has left. Expansion plans have been scaled back, and a competitor is gaining market share. The Epictetus-influenced investor immediately asks, if I had never bought this position, if someone offered me the opportunity to buy this company at $35, given what I know now, would I take it? If the answer is no, they sell, immediately, without hesitation, without hoping for recovery, without calculating how much they've lost. They sell because holding would be an irrational allocation of capital based on present information. The average investor, trapped in sunk cost thinking, asks a completely different question. They ask, how much more can I afford to lose? They ask, what if it recovers? They ask, how will I feel if I sell and then it goes back up? Notice that none of these questions are about the objective investment merit of the position. They are all about the investor's emotional relationship to their past decision. And this is why the average investor underperforms. They are not allocating capital,
They are managing their own psychological need to avoid confronting past errors. Epictetus has one more teaching that completes this framework, and it's about the nature of freedom itself. He writes, "No one is free who is not master of himself." In investment terms, you are not free if you are enslaved to your past decisions. Every losing position you hold for emotional rather than analytical reasons is a chain binding you to your past self. Every moment you spend hoping for vindication is a moment of psychological imprisonment. True freedom means being able to look at your portfolio objectively, to evaluate each position on its current merits, and to make changes instantly when your analysis dictates change. This freedom is not just philosophically valuable, it is financially valuable. The most successful investors in history, from Paul Tudor Jones to Stanley Druckenmiller to Ray Dalio, all share one characteristic: they are ruthlessly willing to change their minds. They are not attached to their past views. They do not hold positions to prove they were right. They hold positions when holding is the optimal use of capital, and they exit positions the moment they are not. And this ability to operate without ego, without attachment to past judgment, is precisely what Epictetus's philosophy teaches. So here is the philosophical foundation we've established. Your past decisions are outside your control. Suffering arises from desiring control over things outside your power. Success means executing your process, not being right about outcomes. Every position should be evaluated as if you were making a fresh decision today. And freedom means being master of yourself, not enslaved to your need for vindication. With this foundation in place, we can now construct a concrete, actionable framework that translates these philosophical principles into specific investment practices that you can implement immediately. That's what we're going to do next. The actionable framework. The Epictetan method for eliminating sunk cost bias. Philosophy without application is academic exercise. What I'm about to give you is a systematic, four-step methodology that embeds Epictetus's dichotomy of control directly into your investment process. This is not theory. This is a concrete operating framework used by sophisticated institutional investors, whether they realize its Stoic origins or not. Each step corresponds directly to a specific teaching from Epictetus, and each step has a measurable impact on portfolio performance. Let's begin.
Step 1. The Fresh Eyes Protocol. This is the cornerstone practice, and it derives directly from Epictetus' teaching that we should evaluate everything based on its present nature, not our past relationship to it. The Fresh Eyes Protocol is simple. At regular intervals, weekly for active portfolios or monthly for longer-term positions, you perform a complete portfolio review in which you evaluate every position as if you were encountering it for the first time. You literally ask yourself, if I had cash instead of this position, would I buy this security at the current price, given what I know now? Here's how you implement this systematically. Set a recurring calendar event for your portfolio review. During this review, you physically write down each position you hold along with its current market value. Do not write down your cost basis. Do not write down your unrealized gain or loss. These numbers are psychologically toxic because they anchor you to the past. Write only the current value. Then, for each position, you write a brief thesis statement. Why do I own this asset? What is the analytical case for holding it at current prices? The discipline here is critical. You are not asking why you bought it. You are not defending your past decision. You are articulating why you should own it now. If you cannot articulate a compelling reason based on current fundamentals, current valuation, and current expected returns, you have identified a position that exists in your portfolio only because of sunk cost thinking. That position should be sold. Not tomorrow, not after you think about it more, immediately, during that review session. Let me be precise about what compelling reason means, because this is where most investors fail. A compelling reason is not, "I think it might recover." A compelling reason is not, "I'm down too much to sell now." A compelling reason is not, "I've held it this long, so I might as well keep holding." These are all sunk cost justifications dressed up as investment analysis. A compelling reason means you can articulate specific catalysts, specific valuation metrics, or specific risk-reward scenarios that make the position attractive on a forward-looking basis. It means you would be comfortable recommending this position to another investor who has no prior exposure and no knowledge of your history with it. This protocol forces you to separate your ego from your capital. Your ego wants to hold positions that vindicate your past judgment. Your capital wants to be deployed in the highest expected return opportunities available right now. The Fresh Eyes protocol ensures that your capital, not your ego, determines your portfolio construction. And this is precisely what Epictetus means when he teaches that we should concern ourselves only with what is in our power. Analysis of current opportunities is in your power. Vindication of past decisions is not. There's a secondary practice within the Fresh Eyes protocol that sophisticated investors use, and it comes from Charlie Munger's concept of inversion. In addition to asking, "Should I own this?" you also ask, "What would have to be true for this position to be a sell?" Write down explicitly the conditions under which you would exit. This is not a stop-loss level, though that can be part of it. This is a comprehensive set of criteria: deterioration in fundamentals, change in competitive position, invalidation of key thesis assumptions, better opportunities elsewhere. By articulating these criteria in advance, you remove the emotional decision-making from the exit itself. You are simply monitoring whether your predetermined conditions have been met. The power of this approach is that it transforms selling from an emotional event into an administrative action. You're not giving up or admitting defeat. You're simply executing a predetermined plan. The decision was already made when you established your criteria. The sale is just follow-through. And this is exactly the kind of pre-commitment that Epictetus advocates. By deciding in advance what will govern your actions, you free yourself from being governed by emotion in the moment. Now, I know some of you are thinking that weekly or monthly reviews are too frequent, that this will lead to over-trading. But understand what we're doing here. We're not trading based on short-term price movements. We're ensuring that every position in your portfolio passes a continuous justification test. Most of the time, your positions will pass this test. Your thesis remains intact, your analysis continues to support holding, and you take no action. But when a position fails the test, when you realize you're holding purely because of sunk cost thinking, you now have a systematic process for recognizing and correcting the error. And that systematic recognition is worth far more than any trading costs you might incur. Step 2. The cost basis blindfold. This practice is more radical, but it is absolutely essential for eliminating sunk cost thinking at the neurological level. The human brain is wired to anchor on initial values. Every time you look at your portfolio and see your cost basis, your unrealized gain or loss, you are reinforcing that anchor. You're reminding your System 1 brain of your past judgment, and you are triggering the emotional machinery that makes objective decision-making impossible. The solution is simple. Remove cost basis from your view. Most brokerage platforms allow you to customize your portfolio display. Go into your settings right now, not later, right now, and configure your portfolio view to show only current market values. Do not display cost basis. Do not display unrealized gains or losses. Do not display percentage returns from purchase. Show only current position size and current market value.
If your platform doesn't allow this customization, create a separate tracking spreadsheet where you manually enter only current values. This may feel uncomfortable at first. Your System 1 brain wants that information. It wants to know whether you're winning or losing. It wants to track your performance against your entry prices. But this desire is precisely what sabotages your decision-making. Epictetus teaches that we must be indifferent to things outside our control, and your past entry prices are completely outside your control. They are historical facts that have zero bearing on optimal capital allocation going forward. Here's what happens when you implement the cost basis blindfold. Initially, you'll feel a kind of anxiety. You'll want to check your cost basis. You want to calculate your unrealized losses. You'll feel like you're missing important information. But within 2 to 3 weeks, something profound shifts. You start evaluating your positions purely on their forward-looking merit. You start asking, do I want to own this asset at this price, rather than how much have I lost on this position? And you will notice, measurably, that your sell decisions become easier. You're no longer fighting the emotional weight of loss aversion because you're no longer constantly reminded of your losses.
This is not self-deception. You're not pretending the losses don't exist. You're simply removing the psychological trigger that prevents you from responding to those losses rationally. You can still track your overall portfolio performance, you can still calculate your internal rate of return, but you separate performance measurement from position management. Performance measurement is a periodic activity, monthly or quarterly, where you objectively assess how your capital has grown. Position management is an ongoing activity where you ensure capital is optimally allocated. These are different functions and they require different information. Mixing them creates the conditions for sunk cost thinking to dominate. There's a parallel practice that enhances the cost basis blindfold, and it comes from institutional portfolio management. It's called marking to market your mental state. Every morning, before you review your portfolio, you take 60 seconds to consciously reset your thinking. You literally say to yourself, either out loud or in writing, I have X dollars of capital today. The only question that matters is whether that capital is optimally allocated today. My past decisions are irrelevant. I am making fresh decisions with current information. This verbal reset might sound artificial, but it works because it explicitly invokes Epictetus's dichotomy of control. You are reminding yourself that past decisions are outside your power, and only present decisions are within your power. The combination of removing cost basis from your view and marking to market your mental state creates a psychological environment in which sunk cost thinking cannot take root. You are systematically eliminating the informational and emotional triggers that cause you to cling to losing positions. And the result is that you start behaving like the most successful institutional investors who evaluate positions objectively and exit immediately when the case for holding deteriorates. The pre-mortem exit plan. This step implements Epictetus's practice of negative visualization in a concrete investment framework. Before you make any investment, before you deploy any capital, you conduct a pre-mortem analysis. The term pre-mortem comes from psychologist Gary Klein, and it means imagining that a decision has failed and then working backward to identify what caused the failure. In our context, it means imagining that your investment has gone to zero and then identifying the specific scenarios that could cause that outcome. Here's the systematic process. You've identified a potential investment. You've done your analysis. You believe the opportunity is compelling. Before you execute the trade, you take out a sheet of paper or open a document and you write at the top, this investment has failed. Capital is lost. What happened? Then you spend 15 minutes generating a list of failure scenarios. Be specific. Don't just write the market went down. Write the company's key product failed FDA approval,
or management was found to have committed fraud, or a competitor introduced a superior technology, or interest rates rose faster than expected, compressing multiples. The goal is not to talk yourself out of the investment. The goal is to identify the specific risks that could invalidate your thesis, and then to establish clear monitoring criteria and exit triggers for each of those risks. For each failure scenario you identify, you write down what evidence would indicate that scenario is beginning to unfold, and you commit to exiting if that evidence appears. This is your pre-mortem exit plan, and it becomes your protection against sunk cost thinking.
Here's why this works. When you've taken the time to imagine failure before it occurs, when you've explicitly identified the warning signs and committed to exit criteria, you remove the emotional shock when those warning signs actually appear. Most investors hold losing positions because they're in denial. They didn't expect the loss, they didn't prepare for the loss, and when the loss occurs, they desperately hope it's temporary. But you've already seen this loss in your mind. You've already accepted it as a legitimate possibility. So when the warning signs appear, you're not shocked. You're simply executing your predetermined plan. This is the practical application of Epictetus's teaching about possessions. Remember his instruction to remind yourself that the ceramic cup is just a cup among many cups, so that if it breaks, you won't be disturbed. The pre-mortem exit plan is how you apply that teaching to investments. You're reminding yourself before you invest that this position is just one position among many possible positions, and that it may fail. You're imagining the failure in detail. You're establishing what you'll do if failure occurs. And as a result, when failure occurs, you execute your plan without emotional turmoil. There's a critical detail in how you document your pre-mortem exit plan. You must write it down. Not just think about it, write it down. Create a document for each position that contains your original thesis, your pre-mortem failure scenarios, and your specific exit criteria. Store this document where you can easily access it during your fresh eyes protocol reviews. The act of writing crystallizes your thinking and creates a reference point that your future self can consult when tempted by sunk cost thinking. When you're holding a losing position and trying to convince yourself to hold longer, you can return to your pre-mortem exit plan and check whether your exit criteria have been triggered. If they have, you sell. No debate, no second guessing. You're simply honoring the commitment that your past self made when judgment was clearer and emotions were neutral. Let me give you a specific example of how this would work in practice. Suppose you're considering an investment in a technology company that's disrupting a legacy industry. Your thesis is that they will capture 30% market share within 5 years based on superior unit economics. Your pre-mortem exit plan might include the following failure scenarios and triggers. Failure Scenario 1. Incumbent competitors respond more aggressively than expected. Exit trigger. If the company's customer acquisition costs rise by more than 25% year over year for 2 consecutive quarters, indicating that customer acquisition is becoming more expensive due to competitive response, we exit. Failure Scenario 2. The regulatory environment changes unfavorably. Exit trigger. If proposed legislation emerges that would require the company to modify its core business model, we immediately reduce position size by 50% and exit entirely if the legislation passes. Failure Scenario 3. Management execution falters. Exit trigger. If the company misses its quarterly revenue guidance by more than 10%, or if there is unexpected turnover in the C-suite, we exit immediately. Notice the specificity here. These are not vague concerns. These are concrete, observable conditions that can be monitored. And notice the pre-commitment. You're not saying, "I'll think about selling if these happen." You're saying, "I will sell if these happen." This removes the decision from your future self, who will be emotionally compromised by loss aversion, and gives the decision to your present self, who is thinking clearly. The pre-mortem exit plan also has a secondary benefit that's worth noting. It improves your initial investment decisions.
The process of imagining failure and identifying specific risks forces you to think more deeply about what could go wrong. Many investments that seem attractive at first glance become less attractive when you systematically consider failure modes. If you find yourself unable to articulate specific monitoring criteria or exit triggers, that's a signal that the investment may be too speculative or too dependent on factors outside your ability to analyze. And that's useful information before you deploy capital.
The opportunity cost forcing function. This is the final step, and it brings together all the previous practices into a single decision framework that makes sunk cost thinking financially impossible. The concept is simple. Every dollar you hold in a losing position is a dollar you're choosing not to deploy in your highest conviction opportunity. When you frame the decision this way, when you make the opportunity cost explicit and immediate, the emotional appeal of holding losing positions evaporates. Here's how you implement this systematically. Maintain a separate list, updated quarterly, of your top 3 investment opportunities that you are not currently holding. These should be opportunities you've analyzed, that you believe offer attractive risk-adjusted returns, but that you don't have capital to pursue given your current portfolio. This list represents your unfunded opportunity set. During your Fresh Eyes protocol reviews, whenever you identify a position that you cannot justify on current fundamentals, you immediately compare the expected return of continuing to hold that position against the expected return of selling and redeploying the capital into one of your top 3 unfunded opportunities. The forcing function is this. You cannot hold a position that you cannot justify unless you explicitly document that you believe it offers better expected returns than your next best alternative. This sounds simple, but it completely reframes the sell decision. You're no longer asking, should I give up on this position? You're asking, would I rather own this or would I rather own that? And when you frame it this way, when you make the trade-off explicit, you will find that most of your losing positions cannot compete. The only reason you're holding them is inertia and sunk cost thinking, not because they represent optimal use of capital. Let me show you exactly how this plays out. Suppose you're holding a position that's down 35%. You're tempted to hold because it might recover. But you have an unfunded opportunity on your list, a position you've thoroughly analyzed that you believe offers a 12% expected annual return with reasonable downside protection. Now ask yourself, do I genuinely believe my losing position offers better than 12% expected annual return from current prices? Not from my cost basis, from current prices. If you cannot honestly answer yes, then holding the losing position is an active choice to accept lower returns. You are voluntarily accepting worse risk-adjusted returns because you are emotionally attached to a past decision. When you frame it this way, the irrationality becomes obvious. You would never call an investment advisor and say, "I'd like to choose the lower expected return portfolio because I want to prove that my past judgment was correct." But that is exactly what you're doing when you hold losing positions rather than redeploying to better opportunities. The opportunity cost forcing function makes this explicit. It forces you to acknowledge that holding is not a passive decision, it is an active choice to forego better returns in favor of ego protection. There's an advanced version of this practice that sophisticated investors use, and it incorporates leverage thinking even if you don't actually use leverage. The question is, if you could borrow capital at zero cost, would you use that borrowed capital to add to your losing position at current prices? If the answer is no, if you wouldn't add to the position even with free capital, then you absolutely should not be holding your existing capital in that position. You should sell and redeploy to opportunities attractive enough that you would add to them with borrowed capital. This question bypasses all the emotional machinery of loss aversion. You're not asking whether you should accept a loss. You're asking whether the position represents attractive use of capital from current prices forward. And most of the time, when you're honest with yourself, the answer is no. You're holding because of what you paid, not because of where it is now. And that is the definition of sunk cost thinking.
Before we move on, I want you to take a moment right now and commit to implementing these 4 steps. I want you to pause this video and write down, in your own words, how you will apply each step to your portfolio. First, schedule your Fresh Eyes protocol review. Put it in your calendar. Second, change your portfolio display settings to remove cost basis. Do it now, not later. Third, commit to writing pre-mortem exit plans for all future investments. And fourth, Create your list of top 3 unfunded opportunities. These are not suggestions. These are the specific practices that separate investors who overcome sunk cost bias from investors who remain trapped by it. And speaking of implementing these principles effectively, if you're finding value in this systematic approach to eliminating cognitive biases from your investment process, I want to invite you to subscribe to this channel. We publish a new documentary every week, each one dissecting a specific bias and providing the philosophical and practical tools to overcome it. This is not entertainment. This is serious investor education for people who understand that superior returns come from superior psychology. Hit that subscribe button now, and you'll join a community of investors committed to mastering their minds so they can master their markets. Now, I know these 4 steps might seem demanding. You might be thinking that this level of systematic review and documentation is overkill, but consider the alternative. The alternative is to continue allowing sunk cost thinking to govern your portfolio, to continue holding losing positions for emotional rather than analytical reasons, to continue underperforming by 3 to 4% annually because you're unable to cut losses. The time investment in these 4 steps is measured in hours per month. The financial return is measured in percentage points of annual performance. That is an extraordinarily high return on time invested. Moreover, these practices become automatic with repetition. The first time you do a fresh eyes protocol review, it will feel awkward and time-consuming. By the 10th time, it will be routine. The first time you write a pre-mortem exit plan, it will feel like you're being pessimistic. By the 10th time, you'll recognize it as essential due diligence. The first time you use the opportunity cost forcing function, you'll feel uncomfortable selling a loss to buy something new. By the 10th time, you'll wonder how you ever invested without explicitly considering opportunity cost. This is what it means to build a system. You create practices that feel unnatural at first, but become second nature with repetition. And once they're second nature, they protect you from your own psychological biases automatically. There's one more element of Epictetus's teaching that ties all of this together, and it's worth making explicit before we move to the question section. Epictetus teaches us that we should view obstacles as opportunities to practice virtue. In Stoic philosophy, virtue means excellence in thought and action, and it is the only thing truly worth pursuing. When you encounter a losing position, when you face the psychological pull of sunk cost thinking, you have an opportunity to practice the virtue of rational judgment. You have an opportunity to demonstrate mastery over your own mind. You have an opportunity to choose principle over emotion. This reframing is psychologically powerful. Most investors view losing positions as failures, as sources of shame or regret. But if you view them as opportunities to practice virtue, if you see them as chances to demonstrate your philosophical development, then they become valuable regardless of their financial outcome. You lose capital, yes, but you gain something more important. You gain evidence of your own capacity for rational action in the face of emotional pressure. And that capacity, once developed, becomes the foundation for superior long-term performance.
This is what it means to master your mind so you can master your market. It's not about predicting where markets will go. It's about controlling where your attention goes, how your capital is allocated, and whether you allow past decisions to constrain present action. These 4 steps, the fresh eyes protocol, the cost basis blindfold, the pre-mortem exit plan, and the opportunity cost forcing function, give you a complete operating system for investment decision-making that is psychologically robust and philosophically grounded. Now let's address some critical questions that naturally arise when you implement this framework. Critical questions on implementing the Epictetan investment framework. Question 1. How do I distinguish between cutting a losing position due to genuine thesis invalidation versus simply experiencing normal volatility? And doesn't this framework risk turning me into a reactive trader who lacks conviction? This is an excellent question,
And it gets at a genuine concern that many sophisticated investors have when they first encounter systematic sell discipline. The fear is that you'll become too quick to exit, that you'll lack the conviction necessary to ride out temporary drawdowns, and that you'll end up whipsawed by market noise. Let me address this directly, because the distinction you're asking about is absolutely critical, and the Epictetan framework actually makes you more capable of distinguishing between these scenarios, not less. The first thing you need to understand is that volatility and thesis invalidation are completely different phenomena, and they require different cognitive tools to identify. Volatility is price movement that occurs without any change in the fundamental investment case. Your analysis of the business remains intact, the competitive dynamics haven't shifted, management hasn't changed, the regulatory environment is stable. The only thing that's changed is the price, and that price change is being driven by factors external to your investment thesis. Perhaps sector rotation, perhaps macro sentiment, perhaps forced selling by leveraged investors. This is volatility, and the Epictetan framework actually makes you more resilient to it, not less. How? Because when you're using the fresh eyes protocol, you're not asking, is this position down? You're asking, does my current analysis support owning this asset at this price? If your thesis remains intact, if the fundamentals haven't deteriorated, if the valuation has actually become more attractive due to price decline, then your analysis will lead you to hold or even add. The framework doesn't make you sell. It makes you think clearly about whether you should sell. And clear thinking in the face of pure volatility will typically lead you to hold positions with intact theses. Contrast this with thesis invalidation. Thesis invalidation means something material has changed that undermines your original investment case. This could be deterioration in competitive position, management execution problems, regulatory changes, loss of key customers, technological disruption, or any number of fundamental shifts. The critical point is that these changes are not about price, they're about the underlying business reality. And when you've written a pre-mortem exit plan, when you've identified specific triggers that would indicate thesis invalidation, you have a systematic way to distinguish between noise and signal. Let me give you a concrete example. Suppose you own a pharmaceutical company, and your thesis is centered on a specific drug in late-stage clinical trials. The stock drops 20% because the biotech sector is out of favor. That's volatility. Nothing about your thesis has changed. The clinical trial data hasn't changed, the market potential hasn't changed, only investor sentiment has changed. The fresh eyes protocol will lead you to hold, because when you ask, would I buy this at current prices given what I know, the answer is yes, possibly even more enthusiastically than at higher prices.
Now, suppose the stock drops 20% because the FDA has raised unexpected safety concerns about the drug. That's thesis invalidation. Something fundamental has changed. Your pre-mortem exit plan probably identified adverse FDA developments as a failure scenario with a specific trigger for exiting. When that trigger is hit, you exit, not because you lack conviction, but because your thesis, the analytical case for owning the asset, has been materially undermined. The distinction is clear when you frame it this way. Conviction is not about stubbornly holding positions regardless of what happens. Conviction is about having a clear thesis, monitoring whether that thesis remains valid, and having the discipline to exit when it doesn't. What most investors call conviction is actually just ego attachment to being right, and that's precisely what the Epictetan framework helps you eliminate. Now, let's address the concern about becoming a reactive trader. The framework I've described does not make you reactive to price movements. It makes you responsive to fundamental changes. There's a profound difference. Reactive trading means making decisions based on price action alone, buying when things are going up and selling when things are going down, being whipsawed by market sentiment. Responsive investing means making decisions based on changes in your investment thesis, adjusting your portfolio when your analysis indicates adjustment is warranted.
The fresh eyes protocol is not a daily practice. It's weekly or monthly, depending on your investment time horizon. You're not reacting to every price movement. You're regularly reviewing whether your analytical case for each position remains intact. Most of the time it does, and you take no action. But when it doesn't, when you realize you're holding a position that you wouldn't buy fresh today, you have a systematic process for recognizing that and correcting it. This is not reactive. This is systematic and disciplined. Moreover, the framework actually increases your ability to maintain true conviction because it removes the emotional noise. When you're not anchored to your cost basis, when you're not defending your ego, when you're not hoping for vindication, you can evaluate positions with genuine objectivity. And that objectivity allows you to hold through volatility when holding is justified, and exit when exit is justified. You're no longer fighting your own psychology. You're using your psychology as a tool for better decision-making. There's one more subtlety here that's worth exploring. Some of the greatest investors, Warren Buffett being the most famous example, advocate for very long holding periods and very low turnover. They talk about buying wonderful businesses and holding them forever. Doesn't this contradict the framework I'm describing? Actually, no. What Buffett and other long-term investors are doing is exactly what the Fresh Eyes Protocol prescribes. They're holding positions because their thesis remains intact, because the businesses continue to be wonderful, because the fundamentals continue to support holding. They're not holding because they paid a certain price. They're holding because the analysis supports holding. Buffett is famous for saying that if you're not willing to hold a stock for 10 years, you shouldn't hold it for 10 minutes. But what he means by this is that you should only buy businesses that you believe will be excellent businesses 10 years from now. He's not saying you should hold regardless of what happens. He's saying you should only make investments that are robust enough to hold through various scenarios. And notably, Buffett has sold positions when his thesis has been invalidated. He sold airlines during COVID. He sold banking positions when the financial crisis made the industry uninvestable. He doesn't stubbornly hold. He holds when holding is justified. The Epictetus framework is completely compatible with long-term investing. If your analysis indicates that a business will compound value over decades, if your pre-mortem exit plan doesn't trigger, if your fresh eyes protocol continues to confirm that you'd buy the position fresh at current prices, then you hold, potentially for years or decades. But you're holding based on analysis, not based on inertia or sunk cost thinking. And that distinction is everything. So to directly answer your question, you distinguish between normal volatility and thesis invalidation by having clearly articulated investment theses and specific, predetermined criteria for what would invalidate those theses. When price declines, but your criteria aren't triggered, you hold. When your criteria are triggered, you exit. And this framework doesn't reduce conviction, it purifies it. You develop conviction in your process, in your analysis, in your ability to think clearly. And that kind of conviction is far more valuable than conviction in any individual position. Question 2. What about tax considerations? Doesn't selling losing positions create a complex tax situation? And shouldn't I consider the tax implications before cutting a position, especially if I'm going to realize a large loss? This is a practical question that every taxable investor must consider, and I'm glad you're thinking about it because it reveals a common form of rationalization that prevents investors from cutting losing positions. Let me be very clear about something from the start. Tax considerations are legitimate factors in investment decision-making, but they are often used as excuses for sunk cost thinking. We need to separate the legitimate tax planning from the psychological rationalization, and then I'll show you how to integrate tax efficiency into the Epictetus framework without compromising its effectiveness. First, let's establish the correct way to think about taxes in the context of cutting losses. When you sell a position at a loss in a taxable account, you create a capital loss that can be used to offset capital gains. In the United States, You can offset an unlimited amount of capital gains with capital losses, and you can also deduct up to $3,000 of net capital losses against ordinary income each year, with unused losses carried forward indefinitely. This is not a cost, this is a benefit. You are converting a dead asset, capital trapped in an underperforming position, into a tax asset that has real economic value. Let me give you specific numbers so you can see why the tax excuse often doesn't hold up to analysis. Suppose you're holding a position that's down $50,000. You sell it, realizing a $50,000 capital loss. If you're in the 37% marginal tax bracket and you have capital gains from other positions, that loss is worth up to $18,500 in tax savings. That's real money. That's not a cost of selling. That's a benefit of selling. You've extracted value from a bad investment by converting the loss into tax efficiency. Now, the concern some investors have is about wash-sale rules. In the US, if you sell a security at a loss and then repurchase the same or substantially identical security within 30 days before or after the sale, the IRS disallows the loss for current tax purposes. The loss isn't gone. It's added to the cost basis of your new position, but you can't use it immediately for tax purposes. Some investors use this rule as a reason not to sell, reasoning that if they can't immediately rebuy the same position, they might miss a recovery. This reasoning is flawed for a few reasons. First, if you're selling because your thesis has been invalidated, you shouldn't want to rebuy the position. You're exiting because the position no longer represents optimal use of capital. The wash-sale rule is irrelevant because you have no intention of repurchasing. Second, if you're selling purely for tax loss harvesting while still believing in the position, you can purchase a similar but not substantially identical security. For example, if you sell an S&P 500 ETF, you can buy a total market ETF, capturing similar exposure while avoiding wash-sale issues. Third, and most importantly, the opportunity cost of holding a bad position for 30 days to avoid wash-sale issues almost always exceeds any tax benefit you might capture. Let me make that last point concrete with numbers. Suppose you're holding a position that you believe is likely to decline another 10%, but you don't want to sell because of wash-sale rules. By holding for 30 days to preserve your tax loss, you're risking another 10% decline on your position. If your position is worth $100,000, that's a potential $10,000 loss to preserve maybe $3,000 of tax benefit. That is not rational. You are making an economically irrational decision because you're focused on tax optimization rather than capital preservation. Here's the correct framework for integrating tax considerations into the Epictetan system. During your Fresh Eyes Protocol review, you evaluate each position on its fundamental merit. If a position fails, if you cannot justify holding it based on current analysis, you flag it for potential sale. Then, and only then, you consider tax optimization. You ask, is there a tax-efficient way to exit this position? Can I harvest the loss against gains I've already realized or expect to realize this year? Can I replace the position with a similar but not substantially identical security if I still want the exposure? These are implementation questions, not decision questions. The decision question is, should I hold this position? And that question must be answered based on investment merit alone. The implementation question is, how should I exit this position? And that question can incorporate tax considerations. But you never let tax considerations override the primary consideration of whether the position should be held. That would be the tail wagging the dog. That would be allowing a secondary consideration to override the primary one. And in my experience working with high net worth investors, this is one of the most common rationalizations for poor investment decisions.
I've seen investors hold catastrophically bad positions for years because they're worried about the tax implications of selling. They watch their positions decline 20, 30, 40%, far more than any tax burden they would have incurred by selling. This is not tax efficiency. This is tax rationalization covering for sunk cost thinking. They're using tax concerns as a socially acceptable excuse for what is actually an inability to accept loss and move on. Now, there is one scenario where tax considerations legitimately alter timing, and that's when you have a position that's at a gain and you're near a long-term capital gains threshold. If you've held a position for 11 months and it's up significantly, you might choose to hold another month to qualify for long-term capital gains treatment, assuming your thesis remains intact. That's legitimate tax planning, because the difference between short-term and long-term capital gains rates can be substantial, 20% or more depending on your tax bracket. But notice what we're doing here. We're not holding a bad position to avoid realizing a loss. We're holding a good position one extra month to optimize the tax treatment of a gain. These are completely different scenarios. Let me give you the systematic approach to tax-aware position management that is fully compatible with the Epictetan framework. First, you maintain awareness of your overall tax situation. You know approximately how much in capital gains you've realized year to date. You know what your expected tax burden is. Second, when you identify positions to cut during your Fresh Eyes protocol review, you prioritize harvesting losses in years when you have gains to offset. This doesn't mean you refuse to cut positions in low-gain years. It means you're strategic about timing when you have flexibility. Third, and this is critical, you implement a maximum hold period for positions you've identified as failing your Fresh Eyes test. If a position cannot be justified on fundamental grounds, you give yourself a maximum of 30 days to exit, regardless of tax considerations. This prevents tax rationalization from becoming an indefinite excuse for holding bad positions. You might choose to exit on day 30 rather than day 1 if there are tax optimization opportunities, but you don't hold beyond day 30 regardless of tax situation. Fourth, you use tax loss harvesting as a regular practice, not an emergency measure. At least quarterly, ideally monthly, you review your portfolio for opportunities to harvest losses that can be used to offset gains. This regular practice means you're continuously extracting tax value from positions that have declined, rather than letting losses accumulate and then facing a large tax decision when you finally decide to cut the position. Regular harvesting also forces you to confront losing positions before they become catastrophic. The psychological benefit of systematic tax loss harvesting is that it reframes selling at a loss as a positive action. You're not admitting defeat, you're executing smart tax strategy. You're converting a paper loss into real tax savings. This reframing helps overcome the emotional resistance to selling that characterizes sunk cost thinking. And this is entirely consistent with Epictetus' teaching about controlling what you can control. You can't control whether an investment works out. You can control whether you extract maximum value, including tax value, from investments that don't work out. Let me address one final aspect of this question, which is about large losses specifically. When you're facing a position that's down 60, 70, 80%, the psychological barrier to selling feels insurmountable. The tax consideration becomes, this loss is so large that realizing it will create a massive tax asset that I might not be able to use for years, and this becomes another excuse to hold. But let's think through this clearly. If you have a position that's down 80%, that means you have 20 cents left of every dollar you invested. The question is not whether to preserve a tax asset. The question is whether those 20 cents are optimally deployed in this position, or whether they should be redeployed elsewhere. Remember the opportunity cost forcing function. If you have better opportunities available, if you believe you can generate superior returns by redeploying that remaining capital, then you should sell immediately. The tax loss you create can be used this year against any gains, and any unused loss carries forward. You haven't lost the tax benefit, you've preserved it for future use. But if you hold the position hoping for recovery, you're tying up capital in what is likely your worst performing investment, rather than redeploying it to better opportunities. The tax consideration is utterly irrelevant compared to the opportunity cost. Opportunity cost. Opportunity cost. Opportunity cost. Opportunity cost.
opportunity cost.
All content provided by the rational investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. If this approach to blending Stoic discipline with financial strategy resonates with you, I warmly invite you to join our community. Hit that subscribe button to get weekly documentaries that empower you to navigate markets with clarity and fortitude. For more on tackling cognitive biases, check out our playlist on Stoic investing principles, linked below. Let's keep building your portfolio strength together, one rational decision at a time.